So looking at the industry itself, this is world trade in the main grain commodities, wheat, corn, barley, and oilseeds. We all know that it's a very consolidated industry. The players in this industry are very big companies, very well capitalized, have been in existence for, I don't know, 200 years, and have very strong market positions. We were a relatively late entrant starting this business 4 years ago, and we had to find a differentiated strategy. We had to find a way to compete in this marketplace that will allow us to win. So the key questions were, which products, which geographies, and which value chain? So if you look at product fit, one of the ways we looked at it is on the left side you see the supply countries, on the right side you see demand countries, the three main products, wheat, corn, and soybeans. And we try to ask ourselves, which of these products fits very well with our geographical strengths? So one of the underpinning theme here is our strength is in Sub-Saharan Africa. That's where we have grown a lot of our businesses, and that's what has allowed us to get market leadership. And between these three products, the one product that fits very well into Sub-Saharan Africa is wheat. It's a significant market. It's about 10-11% of global trade, which is not small, and it's also a growing market. Even on the supply side, we found that there were greater synergies with wheat with our existing geographical footprint. Russia and Ukraine were relatively not fully consolidated supply markets. We had an opportunity to get in there and consolidate our presence. And with the acquisition of Queensland Cotton in Australia, we had developed strong grower relationships on the cotton side, and that could be leveraged also on the wheat side, because at least in New South Wales and Queensland, the growers for cotton and wheat are common. So from that, we derived that wheat is the best fit for us, and our entry strategy into the grain space was based on wheat. This is our strategy page, a one-page strategy slide that talks of what our strategy is. And I think it follows naturally from what I have discussed so far. We said that we want to be a 10% market share in Sub-Saharan Africa in wheat milling. That is the first part of it. And the second part of it is identify specific origins where you can procure and export and trade wheat and still win the game. And those are really the Black Sea countries and to some extent Australia. So we want to invest in logistics assets in these countries in a smart, intelligent way, in those assets that create value in order to make for ourselves a decent competitive position in export and trading of wheat. So in order to do that, we have done acquisitions, we have put up greenfield mills, we have acquired logistics assets, we have built trading teams, and we've been executing on that strategy pretty much to our satisfaction so far.
Sub-Saharan Africa really imports close to about 15 million tons of wheat. It accounts for almost 10 to 12% of annual wheat trade. It's a large market. It's a growing market. It's a market which is characterized by a tropical climate and hence will largely remain a destination market for wheat for the foreseeable future. But what is Sub-Saharan Africa? I mean, it's a big term. We're talking about geography which is almost includes more than 40 countries. So one of the first questions that we had to answer to ourselves was, which countries do we choose? Where do we enter? What should be the first country, second, and so on? What should be our phase one? To answer that question, we put together a set of matrices that you see on the slide here. And then we went about ranking various countries on those matrices. And based on the relative rank, we devised the countries and devised our entry strategy. So let me just take you through some of them in a little bit more detail. So we looked at various things. We looked at things like what is the market attractiveness? That means how attractive is the market? What is the structure of the market? What is the population? What is the demographic? What is the level of development, level of urbanization? Bread, noodles, biscuits, pasta, all of these which need wheat flour are essentially consumed in the urban side. So we looked at these sectors to tell us what is the pie today and what is it that we can aspire for in these markets. We look at the government policies. It's important to have a government policy which is conducive to for agri-processing and specifically the development of the food sector. In any country, if you look at and where you see a very robust downstream business, you will find that at the core of it, at the heart of it, is really a very viable wheat milling business, because that really forms the nucleus. It's from here that you can go downstream into the added products of biscuits or noodles and pasta, where of course our PFB division will take over. Then we also looked at Olam's history in the country, and I think that probably is one of the most important part to focus on, because in a country where Olam presence was there, we could really bring to bear our strengths. We could look at sharing costs, for example, country costs, admin costs, legal costs, to achieve cost efficiencies in the country. We could bring in country capabilities and project management skills that we have developed over a period of time. We have large pan-African networks of customer sharing and of channel sharing that other products of Olam have built, for example, rice, sugar, dairy. And all of these we could leverage together and really bring to bear the strengths of that Olam has built in Sub-Saharan Africa and help us execute our strategies better. We also looked at what are the import tariff structures. The tariff structures themselves are not important. We don't need to have import tariff protection for a viable industry. Industry is viable. Of course, our import tariffs do help in having a better margin structure. But if you just look at the countries, there are two essential factors to focus on. Most of the wheat exporting countries do not tax wheat exports. Secondly, the logistics of movement is overwhelmingly in favor of moving bulk wheat against bagged flour. So these two together ensure that the destination milling always remains viable. So the import tariffs are good. They are good for the margin and hence for the business, but they're not critical. So based on these various parameters, we came up with 4 countries that we wanted to enter in a phase 1. First, we are looking at Nigeria and Ghana, where today we already have a wheat milling business, a very successful business in both the countries. And we have Senegal and Cameroon, where we have ongoing greenfield projects. These are likely to get commissioned in June and December next year. To be the key takeaway is that, ladies and gentlemen, we identified the strategy of wheat milling in Sub-Saharan Africa. And for us, there were 2 pathways. It was acquisition and greenfield. And I think through these 2 projects and these 2 examples, what we did to demonstrate to ourselves and to the larger world was that we could choose either of the paths and execute it successfully and have a business that we can be proud of and lay down the foundation of a very strong and growing businesses.
From a technical perspective, what does the technical team bring? First of all, the technical team obviously clearly understands milling, and one of our key areas is firstly project management, and secondly project learning, and taking our project learnings from the Ghana projects, from the CFM projects, developing our processes, developing our systems, and allowing us to move forward. In the Cameroon and Senegal examples, what we've done is we've built exactly the same mill, or are building exactly the same mill, right down to the office block, the number of offices, the milling process itself. There is absolutely no difference between the 2 processes except for the number and the storage available to us. 20,000 metric tons of wheat in Cameroon and 25 in Senegal. This has allowed us, first of all, to save significant amounts of money, reducing our investment. But also it allows us to put up a mill now in record time. By understanding and using a strong technical sales force and understanding our market, we have been able to segment it, as Saurabh has said, and actually using different wheats and in different improver types, create commercially very viable and suitable products to a huge range of customers. In Ghana, we had started with 1 product. We now have 7 or 8 products, each going into specifically different types of market, whether it's for pasta manufacture, bread manufacture, biscuit manufacture. All of these require different flour types. One other interesting thing that we've done in Ghana is we've developed what we call bakery technical services. And bakery technical services is about trying to break into the market as quickly as we can. We've linked up with a renowned bakery equipment manufacturer in Africa, and we and they have almost what I could call a joint venture. We supply the on-the-ground technical support, they supply the equipment. So we identify various customers, they bring the equipment from the supplier, we install it, we train the bakers, and we then allow them, or they then take our flour. Some of the benefits to the baker are that they are able to increase yields, which is particularly important to them, improve the quality of their product. And there was one significant statistic I learnt the other day. There was one baker came back, and he said that he had saved 50% on his gas consumption, which to him was a lot of money, but of course to us as an international company is reducing our carbon footprint. Finally, we must be doing something right to have gone, for example, in 2011 in Ghana with no flour sales to nearly 80% capacity utilization today. Okay? With our strong technical sales force, I've talked about the diversity of products that we are providing for the marketplace. The other thing that's very important is consistency of product. And we are using new technology, online measuring systems, technology to increase shelf life. Shelf life can be a real problem in Africa because of the high temperatures. We're ensuring that we've got extremely robust food safety processes, investing in metal detectors, magnets, and all of the equipment that one would expect from a world-class manufacturing facility.
Olam's history in Russia is short, but quite notable. We have started in 2009 with a small team of just 3 people, and have grown consistently to become where we are now. Our growth was organic, slow. For a long period of time, we actually were keeping a very, very low profile in the Russian export market. But this was done for a reason. We set us the task of building a very strong foundation for our business, which entails a very robust procurement base, which is Olam's forte in most of our regions and products worldwide. Building a good structure, internal structure, setting the processes right, getting the risk management systems in place, developing a profound understanding of supply and demand, local and global, and ensuring an adequate marketing reach. We have set a network of procurement offices in most of the production areas of Russia. We have manned the team with the best resource we could attract in the market. And upon executing on this part of our development strategy, we felt that we were in a position for a step forward that would take us to the next level. This was when we understood that we could go for an investment. This investment came through in 2012, upon termination of which we became an owner of a port silo in Azov on the estuary of the Don River. This asset has the storage capacity of 48,000 tons. It can load a coaster a day, and its annual throughput capacity is around 800,000 tons.
Olam commenced its grain business in 2009 in Australia and has had very steady growth through that period. Just stepping back for a second into the supply chain, it's important to understand post-deregulation that the Australian government created what they call an open access regime. So everyone in the industry has access to storage and port facilities owned by other operators. Open access is very different from operational control. So even though anyone can go and buy grain at a site and move it to port and put it on a boat, you are beholden to the providers or owners of that asset to provide those services. So having access is one thing. Successfully executing bulk shipments is an enormous challenge, especially when the providers of those services are also your competitor in the marketplace. So our model in Australia at the moment is very much one of a purer trading model, taking advantage of internal trading opportunities in the country, whether that be flat price or basis, importantly trying to service domestic consumption and participating in that container market, which we see continuing to expand into Southeast Asia. But obviously leveraging off the framework on the information within Olam's global grain business, it's a global industry, and it's very important to understand what's happening in Russia or the US or Europe and all of the other major supply and demand points around the world. The model we have in Australia now is going to be very efficient in working capital because we're not obliged to hold and carry grain. It means we can continue to leverage the relationships we have with very significant growers, as Casey mentioned, who supplied the Queensland cotton business in New South Wales and Queensland. And that's going to be very important when I get to my next slide as far as our investment in the port facility. But at the moment, we are trying to reduce our exploitation or manage the amount of risk we take within the supply chain in Australia, but at the same time continue to leverage relationships with growers and build that container and domestic market opportunities. The first step for Olam in infrastructure in Australia is an co-investment in a new export terminal that's currently being built in Newcastle. You can see there, brand new, nice shiny silos, 60,000 tonnes of storage capacity is now complete. This terminal is going to be commissioned in December this year, so it's very exciting. And we're aiming for the first vessels come January, February next year.
We have two sources of competitive advantage. The first source of advantage is quite an obvious one. It's called the Africa advantage. It's essentially our ability to operate in that geography better than most of our global competition majors. But also, with respect to the local competition, we get added benefits because of our presence in multiple products. So because we are distributing not just wheat flour, but also sugar and rice and dairy and to some extent even packaged foods, we get opportunities to share customers, costs, channels and capabilities, and we get organizational synergy benefits. The second source of advantage is a little harder to understand, but is a significant source of advantage for us, which is really we are probably the only miller who is as integrated in the value chain in terms of origination, bulk freight and trading compared to any of our miller competition. And our presence on the wheat, especially on the wheat global trade flows, is fairly significant. We are there in almost every wheat origin. We exist in US, although with a small trading presence, in Canada through the JV, in Australia and Black Sea, you've heard already from David and Alex. And also being present in the bulk ocean part of the value chain, both with our Melbourne as well as our Durban office operating in Pacific and Atlantic. We really understand world wheat trade flows. We spend a lot of time understanding S&Ds and balance sheets, understanding relative value of different wheats at every point in time, and therefore we get visibility to arbitrage opportunities and ability to procure the best wheat at any point in time in order to give us the lowest cost grist. And we execute on it using the benefits that we have of a crack milling team who is able to use any, or not any, but within a limit, a wide varieties of wheat with improvers to deliver a consistent standard flour product, which compared to our competition, we are well ahead on that aspect. So these are the two main sources of advantage that we get in our chosen strategy. And so what's the way forward? So we were selected as an invest and grow platform in the recent strategy refresh exercise that we did at a corporate level, and that's good news. And obviously that is a testament to the fact that we have executed on a differentiated strategy quite well. And we think there are opportunities to grow in the following four ways. First of all, where we have already put up capacities, we will soon and every year see opportunity to increase capacity as we start utilizing greater and greater portions of our existing capacity. We already saw that in crown flour mills. We got into CFM in 2010 and we completed the expansion of capacity just 2 months ago. and we are seeing some very encouraging results in terms of capacity utilization already just 2 months into it. Similarly with Ghana. So even in Senegal, Cameroon, and also the existing markets, we will see opportunities to increase capacity in existing markets. The second, we have a short list of various other sub-Saharan African markets that we have not yet entered, that we can enter, both in West, Central, as well as in East Africa. Then we will also continue to make very prudent, value-accreting investments in logistics assets in those countries where we are already present, which is Russia, Ukraine, Australia, to enhance and consolidate our positions. We're not going to make, I don't think we have the appetite to make a multi-billion-dollar acquisitions, but we believe that we can create extra value at a certain scale and at a meaningful level by consolidating our presence in the origination and trading parts of the business in these geographies. And finally, we will also look at entering some new high-growth milling markets, as a fourth plank of growth.